Jeff Christian, managing partner of the CPM Group, returns to the show. We'll be addressing some of the most pressing questions on every commodity trader's minds. What's happening to the gold and silver price after Trump? What are the Trump trades in regards to commodities? And some geopolitical tensions regarding China and Russia that you may not be aware of. Welcome back to the show. Jeff, good to see you. Good to have you as always.
Good to see you, David. Yeah, thanks for having me.
You were on the show 2 months ago in September. Back then, we talked about the China stimulus trade. People can revisit that interview. Link down below if you like. We'll talk about China further on in the interview, but first, more pressing is what is going on with the gold price. Down $200 from its highs right after Trump won. Actually, it's been sliding a little bit right before the election date, but the slide intensified after the election. So why did gold go down first and foremost? Let's understand why, and then we can speculate as to what's next.
I think to understand the decline in gold prices, you have to take a step back from it. Gold, silver, aluminum, copper, platinum, palladium, oil, natural gas, all fell sharply, starting really, October 31st. And then take a step back from that and you realize they were all rising strongly, really, in the case of gold and silver, from July in through October. So you had a $550 increase in the gold price from July into July 30th. And it was pretty much steady. It wasn't, give and take. There weren't a lot of down days. It was basically a straight line up for $550. Now it's fallen $250. It's back up, $50. So it's like around 2,600 as we speak. But what you saw was a lot of profit taking across commodities. Now, there are people who say, well, gold and silver fell after Trump was elected because people looked at it and said, Trump's going to fix everything. And that's a very naive view of everything, what's going on. But the reality is that the prices of a lot of industrial commodities were falling too. And if you think that the gold and silver prices were falling because of investor sentiment shifting to a more positive view of the economy, that doesn't jive with the fact that you had this broad-based sell-off of industrial commodities that should have been rising if the sell-off in gold and silver were based on economic euphoria. So clearly it wasn't economic euphoria. There was a lot of technical selling that began, as you said, before this thing. Obviously, the reduction of uncertainty with the presidential and congressional elections behind us contributed to that sell-off. You had a lot of people who were buying gold, silver, and other commodities based on the economic and political uncertainties leading up to the election. Those uncertainties disappeared. After a couple of days, people started realizing they've been replaced with a whole lot of new uncertainties. Yeah. Now you see people talking with great confidence about what a unified Republican government means and what a Trump second presidency means. But the reality is it's too early to tell, because if you listen to what these guys have been saying since the election, there's a lot of internal contradictions. And you can listen to some of the things they're saying and say they are going to be slashing spending, slashing government activities, and that could have the effect of pulling a recession forward and making it deeper. But at the same time, they've been saying that, they've been saying a lot of other things that would be extremely stimulative and could extend the expansion that we've been having since 2021. So it's just too early to say what exactly it means to the economy and to gold and silver. Now, you can look at past periods of time when you had a unified Republican government, but I don't think that the Trump presidency is going to be a traditional Republican administration. So I don't know that past examples with Reagan and George W. Bush, I don't know that those are relevant comparisons to what we may see over the next 2 to 4 years.
Yes. I'd like to show you my screen here. This is the US 10-year break-even inflation rate. And let me just zoom into the last year here. It's been trending
Yeah.
up ever since the beginning of September, basically. And if you take a look at the US 10-year government yield, that's been more or less moving in the same
Mhm.
direction, more or less
Yes.
following the inflation expectations of the market. I find this interesting, though, because while the 10-year may have gone up because of higher inflation expectations, and perhaps the 10-year is inversely correlated with gold. Gold should, in theory, and again, this I stress the word in theory, move up as inflation expectations also move up, but that doesn't seem to be the case here. Why?
I don't know that the 10-year is rising on inflation expectations.
Okay.
I think it might be rising on a broader set of economic concerns. Yeah, inflation is in there, but it's quite clear that the Fed and the ECB and other mainstream economists are extremely concerned about recessionary conditions. I've said it before on your show, the Fed would not cut interest rates willy-nilly. They will only cut interest rates when they are more concerned or really concerned about a potential imminent recession. We have seen the Fed cut 75 basis points since September, and that has brought down the 2-year rates and the short term rates, but it's also indicated to the financial markets a greater deal of concern about trends in the overall economy. And on top of the enormous debt that you have in the US government, $1.7 trillion deficit, and the CBOE and other estimates that Trump might add another $7 trillion to the debt over the next 4 years. That all suggests upward pressure on longer term or on interest rates in the longer term. And I think that you're seeing a complex set of economic concerns reflected in higher interest rates on a 10-year note, as opposed to the lower rates that we've been seeing in the 2 years.
Before we continue with the video, I want to tell you about one of the best performing assets this year, gold. The price of gold keeps rising. It's no mystery why. The Chinese central bank is stockpiling gold in the face of deglobalization, while Chinese citizens are buying gold hand over fist to protect their wealth amidst a real estate crisis, a stock market going nowhere, and low interest rates, all seismic shifts for a country that enjoyed immense growth for 20 years. These forces are here to stay, and they're strong. They've created such momentum that gold is now attracting interest from Western investors. The chart is bullish, the arguments are many, and the move is still young. When gold rises, companies putting new gold mines into production usually rise the most. It's called leverage. West Red Lake Gold Mines, today's sponsor, is one of the few Canadian gold stocks putting a gold mine into production in this exciting gold market. The Matson Gold Mine is largely built, and West Red Lake Gold knows exactly what it needs to do and when to achieve its goal of getting this high-grade gold mine back in operation in 2025. West Red Lake Gold is a stock made for this gold market. Learn more in the link down below or scan this QR code here. Do you think inflation will return, though? Forget the
Our
market expectations. What is Jeff Christian's expectation?
Our expectation is that overall inflation, as measured by the US CPI, will range between, say, 2 and 2.5 on the bottom side and 4% or so over the next 10 years. There are clearly inflationary pressures, primarily in the services sectors. There are clearly disinflationary pressures in the non-energy, non-food commodity sectors or goods sectors, and there are deflationary pressures in the petroleum sector. Insofar as we've seen headline inflation come down over the previous several months, it's primarily because of very large declines in petroleum product prices, gasoline and heating oil. And that has offset inflationary pressures that are quite evident in the service sector. We think those longer term upward pressures in the service sector will continue, and that's going to keep inflation rates falling, but we don't necessarily see inflation getting over 4% in terms of the CPI.
How does that line up with your recession outlook? By the way, do you still think a recession is happening in 2025?
2025, maybe 2026. Yeah.
Are you pushing it back after Trump's election?
No, what we're saying is you don't know what the Trump effect is going to be. As I said,
Mm.
some of the things that Trump has said that he's going to do could bring the recession closer and make it deeper. Other things that he said could it push the recession further out. It's just too hard to say. And then you have to take into account the fact that, in the past, he has usually done nothing that he said he would do. So, the Trump election has brought in a whole new set of uncertainties that people have to suss out. And we really won't have a clear indication how it's going to go probably until the second quarter. So our expectation, because this is what we want to talk about,
Yeah.
our expectation is that gold and silver prices will probably rise into the first quarter, but they could back off in the second quarter as some clarity as to what a Trump second term and the unified government means economically.
Well, what Trump did say in his first term he wants to implement tariffs, and the full extent of his promise can be debated, but he did do that. Let's assume he does it again, which is to double down on the tariffs that were already in place during Biden's administration. What will happen to markets if, let's say, tariffs on Chinese imports go up to 60%?
Yeah. First off, he said the 200 number was just pulled out of thin air. He has no idea. Second thing is, you really don't know what he's going to do. Third thing is, 8 years ago, or whenever it was, 2016, he said he would introduce tariffs, and he hardly did anything along those lines. So it's not clear that he will do that. If he does impose tariffs and the Congress allows it to go through, it would bring recessionary pressures closer in because it would raise prices and it would reduce demand for goods and services.
Finishing off on gold, then it would rise into the first quarter of 2025. That's what you just said. So generally speaking, are you changing your outlook for the where your upper end of your target for gold following Trump's election? We can revisit Jeff's call from a few months ago, link down below, but have you changed things basically?
No, what we're basically saying, and let me elaborate a little bit, we're looking for higher prices in the first quarter. We're looking for some reduction or slowdown or plateauing in the second quarter. And then in the second half of this year into 2026, we're looking for still higher gold prices. So we think that we're within 24 months of a peak in gold prices, but the actual pacing is going to depend on a variety of things, including what Trump does or what a Trump administration does, and the inflationary pressures and fiscal stimuli that a unified government might bring. In addition to that, you have to pay attention to what might happen in the prosecution of the Russian invasion of Ukraine, especially now that Biden has allowed Ukraine to defend itself effectively.
Okay, and what is your gold price outlook? Average.
We're looking for gold prices to average around 2,700 or so over the next year or so. And we're looking for a higher average price in 2026. We then think that that could be a cyclical peak, and you could see a period of some weakness, although we think that gold prices on an annual average basis stay above $2,000 for the next 10 years.
Would that translate to also higher silver prices? If you take a look at my screen here, silver has been tracking gold quite clearly. Silver is the bar chart here, and gold is a purple line. Even the uptick recently has been quite closely mirrored. But I'll get your take on silver. You did mention industrial metals going down a little bit, and certainly silver can be interpreted as partly industrial or mostly industrial. So, what's your take on silver here?
Our expectation is that silver prices will rise and probably reach record levels on a quarterly average basis and possibly on an annual average basis. Obviously, if we go into a recession, that will hurt all industrial commodities. If you look at past periods of time when the silver price has risen very sharply, along with other commodities, including gold, in the late 70s, gold and silver and copper and oil all rose in 1979 into early 1980. We then had a recession and they fell back. If you look at the other period of very sharp high silver price increases, it was really 2004 until 2011. And silver prices rose before the recession. Silver prices rose from 2004 to 2007. The recession started in 2007 and ended in 2009. Silver prices rose through the recession. Prices rose past the recession. There were a number of factors that were driving gold and silver prices higher that didn't have to do with the recession or in inflation. There were issues about sovereign debt, U.S. Treasury credit rating, currency market trends. There were all sorts of other factors. You had the Great Recession. You had the global financial crisis. Investors lost $7 trillion during the global financial crisis, mostly in collateralized debt obligations, not only collateralized mortgage obligations, but other debt swaps. You had a tremendous number of economic and political problems going on from 2004 to 2011.
Yes.
It wasn't just the recession. So, that said, recessionary conditions definitely are a headwind for silver prices, but the silver price is determined primarily by investment demand. And those investors were buying silver from 2004 into 2011, A, because the price was rising, and B, because they were concerned about a wide range of political and economic problems.
The Silver Institute is projecting a deficit for the end of the year 2024. Well, that's coming up. I'll let you evaluate that. Has silver actually been in a deficit, and whether or not we will continue to see a deficit, if that is true, into 2025?
We have not been in a deficit if you measure it properly. The Silver Institute's data is inaccurate because they throw in dummy variables for investment demand along with fabrication demand so that they can say that there's been a deficit. If you look at primary supply, newly refined supply coming from mines and secondary recovery, and you measure that as against fabrication demand, we have been in a surplus and we're continuing to be in a surplus. That surplus has been bought up by investors who have been bidding the silver price up away from fabricators and encouraging increased mine production in the long run and secondary recovery in the short run.
Could you make the argument that silver's at least short to medium term price movement does not depend on a deficit and or a surplus? Because if you're correct and it has been in a surplus, well, the price is up 40% year to date. I mean, economic theory would tell you that a surplus would push the price the other way, would it not?
If you look at our data of supply, demand, surplus, deficits,
Yeah,
you get a very accurate barometer for silver prices. And silver prices historically in the 1960s, in the 1970s, 80s, 90s, all along, silver prices have risen when investment demand is rising and there's a surplus in the market, not when there's a deficit. If you look at the deficits that occurred from 1990 until 2005, they coincided with flat to lower silver prices, basically trading between 350 and 550.
what's the logic there?
The logic is that you have several billion ounces of silver that investors own. And unlike in gold, when investors are bearish on silver, they will sell silver. So in the early 1980s, you saw investors bidding silver up away from fabricators. So they were buying silver. That silver isn't fabricated into products. It stays as silver bullion. It's above ground inventories. It's part of a surplus. It's not part of a deficit, right? By the late 1980s, early 1990s, investors had realized that silver wasn't going back to $50 immediately. It touched $50 briefly in January of 1980, and they started becoming net sellers. That pushed the silver price down, which then allowed fabricators to say, oh, silver's $3.50 an ounce. Gold is $350 an ounce at the time. Platinum and palladium are very high. I will use silver wherever I can. And you even saw silver substituted for copper in some applications because it was so cheap. So fabrication demand rises when when investors are selling their silver and the price is low. So you don't necessarily look at fabrication demand as the bellwether of higher prices. You look at investment demand. When investors turn and become more interested in silver, as was the case since 2019, they start buying more silver and the price rises.
Yeah.
That is surplus silver that they are bidding up away from fabricators and bidding to be refined from scrap and mine production.
So what's your outlook for investment demand then?
Our outlook for investment demand is that it probably rises further in 2025 and possibly into 2026. And then it starts to come off depending on what happens in the global economy and the political world. So we're looking for a couple of years, up to 24 months of strong silver prices.
What is needed to push it up to $50 in theory?
More investment demand. I mean, we saw investors buy about 50 million ounces last year. This year, they're probably buying about 70 million ounces, 72, 73 million ounces. And next year, they could buy more than 1 million ounces. Once you get up to that million ounce threshold of investment demand, that starts having an even more dramatic impact on silver prices than what we've seen this year.
And that could, in theory, have a feedback loop if more investors call into silver, pushing the price up. More people will then come in even, in higher volume.
Right. That's exactly what we've seen over and over again in the 60s, in the late 70s, in that period 2004 to 2011.
So 1 million ounces more in demand, investment demand would roughly
100 million.
100 million. So 100 million ounces of investment demand would roughly equate to what kind of a percentage move, according to the model?
We've already seen a big increase because some people are anticipating that, but we wouldn't be surprised to see a record average silver price over $35 an ounce over the next couple of years should investors buy that much silver.
Okay. So copper price, I want to bring up copper because gold, like I mentioned, has been trading alongside silver. Silver follows gold. But has silver also followed copper? There just seems to be a very close relationship between all three metals here.
Yeah. The problem is you've got different scales there. What you really need to do is look at percentage change in prices as opposed to price levels.
Okay.
If you did that, you would see that the correlation doesn't quite fit as much. So here, So there is a close correlation. There's about a 72% correlation between gold price changes and silver price changes. And I think the correlation is closer to about 40% for copper prices. But obviously they all move together. Copper prices have a lot to do with silver prices because you have a significant amount of silver produced as a byproduct of copper. So if you look at the relationship between, say, metal prices and silver mine production, you'll find that mine production is more responsive to copper prices than it is to silver prices because only about 30% of the silver comes from silver mines, but a larger percentage comes from copper mines. So when the copper price is high and producers are increasing their copper production, you tend to see an increase in byproduct silver production that is larger and more dynamic than the increase you see in silver mine production from primary silver mines when the silver price rises.
I want to touch on geopolitics now. You mentioned to me offline that you've been talking about the tension between China and Russia, which is not something that we hear a lot about in the mainstream news. What's going on there, and what is the market impact of that dynamic?
The West has tended to think of Russia and China as colleagues. And when I went back to university after taking some time off when the U.S. draft ended, one of the first courses I took was a graduate level seminar called the Sino-Soviet conflict. And the Sino-Soviet conflict really emerged in the late 40s, early 50s. And the two countries, have the longest border with each other and have a long history of problems. So I won't bore you with the history too much, but if you go back to 2023, Xi Jinping went to Moscow for a state visit, and it was a big deal. And Vladimir Putin set up several agreements that he had hoped they would sign. One of them was an agreement that the Chinese would finance exploration and development of oil and gas in what they call the Russian Far East, and then build pipelines so that they could pipe the oil and gas into China and buy it. And he had drafted these agreements and set up the time for a official ceremonial signing of these agreements. Xi Jinping said, we're not signing those. You're talking about what you call Russian Far East. We call it Russian Manchuria. It's land that was Chinese that the Tsar took away from us in the 19th century. After World War II, Manchuria was divided by the Allies. Part of it went back to China. Part of it stayed with Russia. Mm-hmm. You want us to pay you to develop natural resources on land you stole from us and then pay you for the natural resources. That's not going to happen. So Russia invaded Ukraine. Russia needs arms. It needs money. It needs allies. China has grown pessimistic about the way the Russians are prosecuting the war in Ukraine. And they're very pessimistic because they're watching it and saying, if Russia is having this much trouble trying to take over the Ukraine and it's got a land border, this suggests that we could have even more difficulty trying to reunify with Taiwan militarily. So maybe we just need to go back to what the policies have been over since the late 1970s and say, ultimately, we will find a political way to reunify with Taiwan. There's a lot of internal dissent and discussion within China. There's a lot of internal dissent and discussion within Russia, much more so in Russia, going on. So China basically said, we don't want to provide you more arms and more support for your Ukraine war. You've really mucked it up. And you've really reduced your status on a global platform stage. So Russia has now turned to North Korea, which has its own issues with China. China has said, we don't like the fact that you're taking troops from North Korea, and don't you dare put them on the Russian-Chinese border, freeing up Russian troops to go to Ukraine. So the troops have been deployed into Ukraine. There's a tremendous uncertainty as to what's been happening with those North Korean troops. The Ukrainians have been saying that they have been a combination of being killed and deserting, but that's the fog of war. You can't go by what they're saying. So there's a lot of tensions between Russia and China has said, if you want more aid and support from us, give us Manchuria back. And maybe throw Vladivostok in. Well, that's not going to happen peacefully. Russia will not give up Vladivostok. So you've got a lot of tensions between those two countries, which people in the West are pretty much totally oblivious of.
Biden just gave Ukraine the okay to strike into Russia using long-range missiles. But anyway, the administration is responding to the North Korean troops in Ukraine presently. So how does this change the dynamic between not just Russia and China, but Russia, China and the U.S. now that Russia has, I guess, employed the help of North Korean soldiers on the border?
Well, the important part, the first part is let's see what happens now that the Ukrainians no longer have their hands tied and they can prosecute the war effectively and efficiently. They could ostensibly end the war before Inauguration Day, given the armaments that they're getting from the United States, the UK, and continental Europe. So it remains to be seen what happens there. I think that within China, there are groups that would like to see a more peaceful relationship and cooperative relationship with the United States. There were overtures that were made over the course of the last 12 months or so. They were rebuffed by the U.S. government. It remains to see what the U.S. government under Trump is going to have in terms of its posture with China. It was very uncertain in his first administration. It's probably going to be very uncertain in the current administration or the upcoming administration too. So I think there's a lot of moving parts there, and that creates a lot of uncertainty. And I should say you also have a lot of moving parts and political issues in the Middle East that are not necessarily well appreciated by Western investors.
And so ultimately,
that's a whole nother interview.
Yeah, we can definitely touch on that later. What ultimately is the impact of this uncertainty on commodities?
It tends to increase demand for gold and silver. It tends to reduce overall economic activity, which becomes a headwind for industrial metals, platinum, palladium, copper, aluminum, and other industrial metals.
Very good. Thank you very much, Jeff, for your update. Where can we learn more from you in the CPM?
You can go to www.cpmgroup.com. There are free reads and free videos that you can get there. You can buy our yearbooks or our precious metals advisory or other reports from the website. You can go to YouTube, where we post free videos twice a week on YouTube on a variety of subjects. And then you can send an email to us at info@cpmgroup.com asking us to be in touch with you to discuss how we can help you manage your commodities exposure more effectively.
Good. We'll put the links down below. Thank you very much, Jeff, and thank you for watching. Don't forget to like and subscribe.